So by the time you're done with this video, you're going to be in a position to show how risks occur in real business in supply chains, classify internal and external risks in any supply chain, and practically look at risks management strategies. Of course, if at any given point you like the content, make sure you hit the like button, you subscribe. Those things are free and they are properly helpful. There are a number of issues that increase the risks in global business environment. For instance, geographical distance, integration between economies, climate change, political instability, etc. What exactly does any of those things, what exactly do any of those things mean in a supply chain? It means a supply chain manager needs to have capacity to balance the potential impact of a risk with the potential opportunities. So let's take something like the Russia-Ukraine conflict. I mean, how long has that thing been going on for? Since I think 2022 or something. So Ukraine is big on exporting things like grain, sunflower oil, while Russia, supplies large volumes of natural gas, crude oil, and fertilizers. And with the war, you have blockades, sanctions, and other things that affect supply chain. Globally, this means that supply chain managers have to respond. They have to respond to, especially if whatever you're doing or whatever you're using came from those parts, then you can't just be like, well, there's a war going on and therefore, no, you have to respond to that. And that will mean things like finding other suppliers for grain, like Brazil, logistics rerouting, with Black Sea port blocked, supply chain managers coordinate rail, road shipments through Poland, Romania, the Baltic states to move Ukrainian exports. The point is, as a supply chain manager, you have to be in a position to identify risks and come up with risk management strategies. Now let's start with the basics here. Let's start with understanding something like what is risk. So in a simpler term, a risk is the possibility of something happening. If something is unlikely to occur or is not measurable by a manager, then this is defined as an uncertainty. The truth is, there are a lot of uncertainties in business. We just got good at measuring them and figuring them out. For example, the weather. Using weather tools to predict how the weather will be like next year is a wastage of time. But the same tool can help us to know what to expect tomorrow. So the point is for you to remember that risk, as we're continuing. Risk can be positive, risk can be negative. It just depends on how you go about it. And at this point, before we jump into the next thing, let me just point out that if you are into business, like you're looking at this one and then I think, I want to be in logistics business. Yep, there's a PDF that you can access. It has 19 business ideas, 19 logistics business ideas that you can start. And we've looked at them in terms of cost of starting those things, the technology involved in starting those things, how easy or difficult it is to get into the market, right? All that. In addition to that, you also get a series of materials that will help you to go from just having an idea all the way to executing on these ideas. So things like figuring out who your customers are, designing your competitive advantage, doing your customer personas, all those things, make sure you check them out. Let's talk about types of risks. Now, the type of risks that will exist in a business, all these risks, they tend to be the same. The difference is always just the likelihood of occurring and the impact. So we're talking about supply chain related risks. These risks are more or less the same whether you're talking about the corporate level or the business level. In fact, a small corner shop will be far less affected by risks of foreign exchange fluctuation than a large multinational company that moves capital and goods across border on a day-to-day basis. But both the small business and that big company are still going to be affected by currency fluctuation. So the only difference is the magnitude. So it's not like if, that's big people problem and this is small company, whatever. They're all going to be affected. The magnitude is what differs. Risks can be internal or they can be external. So example of external risks in this case, we have supply risks, which are risks caused by factors such as any interruption to the flow of product, whether raw materials or parts, poor quality of supplied products, subsystems, components, and materials, quality and management issues arising from outsourcing, variability in lead times, or even delays in transportation. So most of these ones are just going to be upstream related, okay? They relate to the upstream aspect of your supply chain. Then we also have demand risks. So in this case, you're looking at the buyer side of things. And the risks here are caused by factors such as unpredictable or misunderstood customer or end customer demand, loss of major customers, volatility of demand, concentration of customer base, short life cycles, inaccurate forecast. We have environmental risks. So these are risks in the area that supply chain is taking place. And they include things like the macro risks or economic shifts, recession, exchange rates, social or labor unrest. We have natural disasters, we have climate factors, we have policy risks, okay? And then we have business risks, which in this case are caused by factors such as a supplier's financial or management stability. We also have purchase and sale of supplier's company. Those are external risks, but then we also have internal risks. So which are the internal risks? Remember, these are risks. Internal risks are risks now inside your organization. That there are risks that your organization, basically they have to do with the organization, because external have to do with the environment in which your organization is operating under. So in this case, we're talking about things like managing things like manufacturing and process risks. For example, machine breaking down. We have business risks, which could be caused by things like change in key personnel, business process, such as the way purchaser communicate to supplier and customers, network planning and control risks. We have security risks, we have mitigation and contingency risks caused by inadequate contingencies to cover unforeseen events. We also have cultural risks caused by a business cultural tendency to hide or delay negative information. So look, the point is just what exactly are risks, okay? And what are some of the types of risks that you could be dealing with? And from a global point of view, okay, that's what you're looking at here, because if you're just saying, well, risks, blah, blah, blah. No, I wanted to look at this risk not just in terms of how they affect your business right now, but if you're dealing with supply chain on a global scale, how exactly do those risks affect you as well? Let us now talk about risk management strategies. The first thing you need to do is identify the risk. After identifying them, you have to classify them in terms of the likelihood of that risk happening and the impact, okay, if it happens. So is it severe? Is it mild? Is it, all that. So once you've done that, then you can come up with strategies to deal with those risks. And risk management is the process of identifying, then strategizing a resolution to a risk or series of risks. Now, in some companies, we have people whose job it is to specifically figure those things out. Like they just have a risk management department, something like that. Okay, the way they'll call it will obviously differ. But the supply chain manager has to engage in risk management activities on an almost daily basis in order to balance the risk and rewards from every supply chain action. And there are 4 classic ways of dealing with risks. So in this case, we're talking about tolerate, treat, transfer, or terminate. And here's how a supply chain manager can use any of those strategies. So let's start with tolerate. And in this case, the risk could be too small to justify the action to be taken. Okay. An example, if you run a global apparel company importing cotton from India and you're aware of an oncoming monsoon, you can accept seasonal delays caused by the monsoon. Now, what you're actually going to do, okay, just I'm like, yeah, there's a monsoon, you've accepted it. Nope, you could have buffer stock because you know that, well, that's a possibility. The weather can be bad and then you can't have import and then there is that. Now, number 2, treat. So in this case, you aim to reduce the risk by taking proactive measures to minimize the likelihood or impact of the risk. Let's say you are an automobile company, and in this case, you are getting your semiconductors chips from Asia. Now, you just can't be like, yeah, well, Taiwan, they make good semiconductors, and therefore I'm just going to rely on that. What if one day there's a problem there? So the way to deal with this sort of risk will be to have several suppliers in several regions. That way, yes, you have your dominant supplier, but then you have these other suppliers. So if things don't go according to plan, you can switch. That is the reason why companies like Apple have all these lists of suppliers. And at some point, they even do them in-house to avoid the problems associated with like anytime there is an issue between, say, China, US, and then Taiwan is involved in that, and then you end up having all these semiconductors problems. Like the other time you saw when there are all these tariffs and stuff, which, whatever, political. And then companies like Nvidia, okay, they are to cut a deal. They're like, okay, look, we're going to pay you this percentage to the government so that our goods from, say, China aren't going to be tariffed this much. So those are things that happen politically. And so you're trying to avoid that by fixing your supply chain, by treating. Now, number 3, transfer. Okay. In this case, the supply chain manager shifts the financial or operational consequence of risk to another stakeholder, often through contracts or insurance. So a shipping company, for example, that is moving goods, okay, and maybe the route they're using is prone to things like piracy. So that shipping company can purchase a marine insurance to cover losses if vessels are hijacked, okay? Now, in this case, the risk is still there. So by buying insurance doesn't mean that now you've gotten rid of the risk. What you've actually done is you've just shifted the financial and operational burden in this case. And so the 4th one is to terminate. Now, in this case, you look at the entire thing and then decide, well, it's not worth it. Let's just abandon the whole thing. Now, look, you could be looking at this one and thinking, yeah, well, those scenarios, different companies, but is it possible for one event to occur and then in that one event, we apply all the 4 T's? Yes, okay. I mean, yeah, I've given you different scenarios, different examples. But if you look at something like the Red Sea crisis, okay? So sometimes back, I mean, the Red Sea's issues. So we have these groups that are attacking seas there, attacking ships there, okay? For reasons known to them. Some of these reasons are political, some are just theft, whatever. All right, look, it's complicated, man. People just have to make money. And some of the ways they go about them are, yeah. So what happened? In this case, that led to shipping companies like Maersk, MSC, Hypergloy to suspend their Red Sea operations, forcing rerouting around the Cape of Good Hope. Okay? So that's it for these companies. They're like, yeah, well, let's not just use that route anymore. Let's use others. But then there are companies that elected to go with the treat option, which means they looked at the odds and decided, well, those people are targeting those particular shipping companies. Ours are too small. They're not going to do anything. So let's just continue the operations. And they continued the operations. Went through that, used the Suez Canal, and continued. But then there are others which elected to treat. So large firms, okay, didn't leave things to chance. So they hired private escorts, okay. Some adjusted their shipping schedules to avoid high-risk windows. Others increased their buffer stocks, okay. Of course, that didn't eliminate the risk. It sort of just reduced the exposure to the risk. Other companies chose to shift the burden to third parties, okay. Of course, some chose to stop the entire thing, as you've already pointed. They're like, yeah, we're not using that anymore. So if there is any question, you ask, all right? Now look, if you're serious about starting your own supply chain business, related business, or logistics and things of that nature, okay? Here's a video about 5 things that you need to pay attention to avoid failing in your business. So check it out. See you in the next one.